Listen, if an index universal life policy is funded properly and distributed wisely, you never have to worry about outliving your retirement. Let me repeat that one more time, because I really want that to sink in. If the agent you're working with, perhaps the one who referred you to this video, build your index universal life policy so you fund it properly and distribute the funds wisely, you will never have to worry about outliving your retirement, especially if the agent has been trained by me and my team. Why? Because our primary focus is growth without risk, protection, and income for life. Not only that, you always have access to your cash. Unlike your 401k or your IRA, where you have to wait till you're 59 and a half to access it, here's the best part. Your money is available to you tax-free. I found no other place to put money that can do that. I hope I have your attention now. Please focus as I explain how this amazing product can work for you. The Index Universal Life product was created to allow you the potential to earn market gains without exposing your principal to market risk. In other words, you can run with the bulls without any concern of the bears. It does this by using an equity index like the S&P 500 to track and credit market gains. However, your money is not in the market. The interest you earn is based on the index performance. This allows the insurance company to put in place some powerful safety features that you simply cannot do on your own. One of those features is the index cap and the index floor. These are terms you probably have never heard before, but they are extremely easy to understand. Here's how they work. The Index Universal Life contract credits the equity index performance annually to your policy cash value. The floor means if the S&P index goes negative from your policy anniversary date to the end of the year, your annual earnings from the index would be zero. You do not participate in the index loss during a bear market. This protects your cash value when the market drops below zero. It's your safety net, and it's a contractual feature of your Index Universal Life policy. Because the floor is permanently set to zero, you can never lose money from a market dip or a correction. When the S&P index has a positive gain, the index cap percentage is the highest percentage gain your cash value would be credited for that year. On this illustration, the cap is set to 13. The insurance company sets these caps. I have seen these caps as low as 8.5% and as high as 17%. Each insurance company is different, and the caps can change annually. This is how the cap and the floor feature work. There is another feature the Index Universal Life policy has that separates them from all other financial products. It is the lock-in of the annual gains. It's the second layer of protection for your money. Here's how lock-in of the annual gains work. If I have $100,000 of cash value in an Index Universal Life policy and the market went up 10%, my cash would be credited $10,000. That $10,000 would be added to my principal, and I would have a new account value of $110,000 never to be given back. If the market went down 10% in an equity account without a cap and a floor, I would lose 10% of my $110,000 or end up with less than what I started with, $99,000. By sustaining what was earned, even a modest 5% return the next year grows the cash very nicely to $115,500. By losing just 10% in 1 year creates an 11% difference in the accumulation value in this comparison. It's a difference of $115,500 versus $103,900. One of my core beliefs is you should never interrupt compounding, and the Index Universal Life policy accomplishes this. Consistent annual compounding growth will outperform erratic, unpredictable, speculative risk, which I will prove to you in just a second. One of the most common mistakes Americans make with regard to their finance is failure to understand how powerful compounding interest is. It's easy to see the benefit of compounding interest when looking at a rising chart of exponential growth. But when the market has a major correction, like the last one in 2008 and 2009, it can take years just to break even. That is one of the worst things that can happen to you, especially if you're about to retire. If you're over 45 years old, you simply do not have enough time to interrupt the compounding process. Keeping your money working for you at all times is critical to achieve your financial goal. I will teach you in another video how uninterrupted compounding works and how you can use the Index Universal Life policy to grow your money in an uninterrupted compounding environment, yet still have access to those funds when you need it. Let me continue to share with you why avoiding market losses are so beneficial in creating wealth. In our previous example, our $100,000 experienced a 10% gain, a 10% loss, and a 5% gain, giving us an ending balance of $103,950. When the market tanked in 2009 by 37%, the $103,950 account diminished to $65,480. By 2010, the market ran up 26%, but our account value isn't anywhere near back to where we started with. This is how the market works, and certainly a place I'm not interested in parking money. If your money had been in an Index Universal Life policy in 2008-2009 like mine was, your cash would have been protected because of the zero floor feature, and you would not have participated in the major losses millions of others in the equity accounts experienced. There's another strong feature of the Index Universal Life policy that protects your gains and keeps your cash continuing to grow. It's called the reset feature, and this is one of the greatest features in the product. It resets the equity index value on the anniversary of your Index Universal Life policy. In this example, the S&P index dropped from 1,447 to 902. The year after it dropped, the Index Universal Life policy started with a new index value of 902, not the 1447. The Index Universal Life policy would count your gains in the equity index for the next year from the new value of 902. In this case, the market increased by 26%. The Index Universal Life policy is capped at 13, but the cash value is earning 13% on 115.5 versus 26% on 65,000 we were left with in the exposed open market example. It is important to point out that the S&P index value hasn't gotten back to the 08 starting value of 1447, yet the cash value in the Index Universal Life policy has grown by an additional $15,000. There is no other product I know of that can protect and grow your money like this, and that's why my life savings is in several Index Universal Life policies. Let's compare an Index Universal Life contract to an S&P equity index account over the past 15 years to see how beneficial caps and floors, lock-in and reset really are, and why it's important to you, the person taking on all the risk. I will use the historical S&P 500 equity index total returns, including the dividends, compared to the Index Universal Life contract with a cap of 13 and a floor of 0. Neither of these illustrations are taking into account any annual cost. The Index Universal Life has no mortality costs or fees subtracted, nor does the S&P index have income taxes or management fees assumed. This will give us a better understanding of how the Index Universal Life cap and floor and lock-in and reset features work. Let's start with an initial account balance of $100,000. We can see right away how beneficial the floor feature works from 2000 to 2002 when the market went down 3 years in a row. As the equity account lost value, the Index Universal Life policy sustained its value of $100,000. It didn't make any money, but more importantly, it didn't lose any. In 2003, when the market rebounded, the S&P equity index account gained a whopping 28%. Even though the equity index account gained this double-digit return, because the account had lost so much money from 2000 to 2002, you can see the account hasn't regained its losses yet. Now look at the Index Universal Life policy. Because it didn't lose any money during the 3 previous years, the initial $100,000 account value enjoyed a 13% gain. The difference in the value in year 4 on these two accounts is there is $80,000 in the open market account versus $113,000 in the Index Universal Life cash value. The floor feature protected the money, allowed the cap feature to take advantage of the majority of the market upside potential without participating in the downside. Over the past 15 years, using a 0 floor and a 13% cap in the Index Universal Life policy fared very well compared to the open market. In this example, $85,000 better. Doing a historical comparison is pretty telling. By now, it should be obvious why I chose the Index Universal Life product over the open equity market. why I've safeguarded my client savings with the Index Universal Life policies, and why I think it's a better option for you too. Today, you've only seen the tip of the iceberg. There's much more for you to discover over the next few days. Let me go over again why I prefer the Index Universal Life policy over every other financial savings product on the market. I get to benefit from the upside potential of the market. When there's a bull run in the market, my cash value grows. But I'm not exposed to the market risk when a bear market begins, and my gains are always locked in annually. The biggest advantage is I can grow my money in a tax-free environment where I have access to the money whenever I need it. If I get sick, I can access the benefits of the policy, and if I die, my wife and daughter are taken care of with the death benefit after I can't. I have great peace knowing my ladies are protected and all this money will transfer to them without taxation. This is why I call the Index Universal Life contract my family financial miracle.